Hello everyone. Welcome to our review for test 2. This time we are going to go over allowance for doubtful accounts and how all of that works. Here, if you check on top, I've created a list of all the topics that you'll have to cover for test 2. You have a bank reconciliation, you have your two types of investments, your revenue recognition, allowance for doubtful accounts, four types of inventory, depreciation, which is of three types, and the journal entries involved with selling property, plant, and equipment. So for very first video, we'll be going through we'll be going through allowance for doubtful accounts and accounts receivable, and all the journal entries involved in that. So the very first thing I'll bring your attention to is this T table that I've created. This gives you a basic overview of what all allowance for doubtful accounts questions will involve. These are basically the blanks that you'll have to fill for each question. Each question will first of all start with a starting balance. You'll have the starting balance for your accounts receivable, and you'll have a credit balance for your allowance for doubtful accounts. Next, you'll be told how many credit sales have been made over the course of the year. These are the sales that would have been made on credit, which means that we'll be debiting accounts receivable and we'll be crediting revenue. Then there are collections on these credit sales, which means how many of the people who owed us money have paid us the money. In this case, we'll be debiting cash and crediting accounts receivable, which is the collections written right here. And at each time, we'll consider that certain amount of accounts receivable we assume are uncollectible, which is what a write-off will be. So we'll remove those items from the uncollectible accounts from accounts receivable, and we'll move them here to allowance for doubtful accounts. So in that case, we're crediting accounts receivable and debiting allowance for doubtful accounts. After that, some of the accounts that we've written off unexpectedly ended up paying back the amount they owed us, which is what the recovery right here is. Just remember, for all other journal entries, there'll be two entries involved. But for recovery, there will be four. So the very first thing is we'll reverse the original journal entry. We'll add back the balance in allowance for doubtful accounts. So the very first thing we do is we debit accounts receivable and we credit allowance for doubtful accounts for the amount of recovery. Then next, we will credit accounts receivable and we will debit cash for how much ever that amount was. At this point, you should have filled in most of this table. So at this point of the question, you'll have all of the values. The only ones which will be missing at this point will be the end balance and the bad debt expense. Now, depending on what the question tells you, we'll determine one of these two next. In case we are told that is the balance sheet approach, which is the one that's most commonly tested, in that case, we'll only be dealing with balance sheet accounts, which means that we'll determine how much the end balance of allowance for doubtful accounts is based on a percent of accounts receivable. So in this case, in this question, that's what we'll be doing. We'll determine what the end balance of allowance for doubtful accounts is. And at that point, all these others will be known values. And this bad debt expense will be the only unknown. And then we can find this out and make an entry for bad debt expense. This again is the balance sheet method. However, there's another method, which is the income statement approach. In the income statement approach, once again, there'll only be two unknowns, which will be the bad debt expense and the end balance. But in this case, since it's the income statement approach, we will only deal with the income statement items, which means we'll take a percent of credit sales and we'll take an X% of that. So let's say if it's 3%, the question will tell you this. We take the 3% and we take that percent as the bad debt expense. Now, as you can see, sales and expense are both income statement items. So we take a percent of credit sales and assume that value to be a bad debt expense. And then we'll make a bad debt expense entry for that, in which we'll debit bad debt expense and we'll credit allowance for doubtful accounts. And after that, we'll next calculate the end balance. for allowance for doubtful accounts. So as you can see, they take a different approach, and the question will always tell you which approach to use, or they will indicate by telling you that will be a percent of accounts receivable, in which case you immediately know that you're using the balance sheet approach. Or alternatively, as it is in this question, it may give you something that's known as the aging of accounts. So as it says here, calculate, so this company began its operations and it calculates its allowance for doubtful accounts by aging its accounts receivable based on the following percentage. So aging of accounts is this table right here. So this means that since we are aging accounts receivable, this is the balance sheet approach. Which means we find whatever percent. So we take 1% of this amount, we take 5% of this amount, we take 20% of this amount, and we take 80% of this amount. And whatever values we'll get for that, we add them all together. And that value that we get at the end is what our end balance for allowance for doubtful accounts. So this value, we'll put it in here, which means the only unknown that we'll have will be the bad debt expense. And then we'll find the bad debt expense out. So let's go ahead and start solving this question. So the very first step is, let's just go through the question again. It gives us the following information relating to the year December 31st, 20x1. It tells us that the credit sales in the year were 3 million. And then we collected, on those credit sales, we collected this much amount of money. Then 27,000 worth of accounts were written off. And we recovered accounts which were previously written off worth $7,000. And it tells us what our AR starting balance and the starting balance for allowance for doubtful accounts is. So let's go ahead and start solving this. The very first thing that I like to do is let's just fill in the values according to this table. So our starting balance for allowance for accounts receivable is a 3841 is a debit balance of 300,000 3,084 300,084,000. Sorry, got a bit mixed up in words there. So next we have allowance for doubtful accounts. We have a 27,840 credit balance for that. So let's go ahead and add that value in here. Now these two are our starting values. Next, we are told that credit sales, which is the one here, was worth $3 million. So let's go ahead and put credit sales in here with 3 million. Out of these 3 million, we ended up collecting 2,915,000. Okay. Next, we are told that we wrote off 27,000 worth of accounts, which means we took 27,000 out of accounts receivable and we transferred that into our allowance for doubtful accounts. So let's go ahead and do that. 27,000, I'm going to put this in blue. And we transfer that here, which means we're writing off those accounts. However, it turned out that 7,000 worth of accounts ended up being unexpectedly collected. We didn't expect to collect those, but we ended up collecting those. So let's put that in as well. So first of all, let's add that balance back into the allowance for doubtful accounts. Then remove that amount. Sorry, add that amount back in accounts receivable. Then since we've received cash for it, we'll remove that amount from accounts receivable and debit cash for that much amount. Next, the only part that we'll be missing here are the bad debt expense and the end balances for both of these. So we can use a calculator and easily find out what the end balance for accounts receivable is. You can do that yourself. I'm doing that on my calculator right now. and I have a positive balance of hopefully all of you got a similar answer. Now, in this question, we are given an aging of the account. So let's go ahead and age these accounts. So we find 1% of this amount, which is 2770. Next, we find 5% of 80,000. I'm just going to do that on my calculator. That gives us 4,000. Next, we find 20% of 60,000, which is 12,000. And lastly, we find 80% of 25,000, which is 20,000. Now add all these numbers up and we should get 38,770. Now this amount that we got at the end of aging our accounts is what our end balance for allowance for doubtful accounts will be, 38,770. Now, had they not given us aging of the account, they might have said that 3% of the end balance of allowance, our accounts receivable, say 3% will be the end balance for allowance for doubtful account. They could have done that, but in this case, we have aging of the accounts, so just ignore that. Right. Now that we know all of these details, the only one that's missing in this is the bad debt expense. So we can easily find that out. 27,000. Let's do the math for that. So these two numbers adding up, so let's add those. 27840 plus 7,000 gives you 34840 plus bad debt expense minus 27,000 is equal to 38,770, right? Now, let's keep this term and move the other terms to the other side. That gives us bad debt expense is equal to 38,770 plus 27,000 minus 34,840. Now do this math and it should give us a value for the bad debt expense, which happens to be 30,930. So now we know that's how much the bad debt expense is. So now let's go ahead and write the journal entries for all of them. Now, an important thing to note, you could have done the journal entries at the same time as writing down all of this stuff. So just as we were filling in a T table, you could have done it. I, as a personal choice, prefer to do it at the end, but you can pick whichever one you want to do. So to make our journal entries, let's just start from the very first one. Let's start with credit sales. So credit sales. So for that, we'll debit accounts receivable and we'll credit revenue. And that's for 3 million. As you can see here, it's 3 million. And let's see here. Thanks. Now the next one tells us that we collected 2,915,000 worth of dollars. And so let's do that. Cash collection. In this case, we debit cash because we received cash and we credit accounts receivable for 219,512. And now let's go to part 3, which is the write-off. So when we wrote off, we credited accounts receivable and we debited allowance for doubtful accounts. So let's do that. So a write-off is allowance for doubtful accounts debit, and we credited accounts receivable for 27,000. Right? Now, next we do a recovery. Remember, for recovery, there are 4 entries involved. Do not forget that. So, recovery. First, let's return the balance to allowance for doubtful accounts. Remember, allowance for doubtful accounts credit, and we debit AR. Next, we debit cash and we credit allowance, our accounts receivable. And that is for $7,000. So let's add the amount. There you go. For recoveries, we have 4 journal entries. Now, the only one that we are missing is the one for bad debt expense. So 5 bad debt expense. So in this case, we'll debit bad debt expense. We credit allowance for doubtful accounts. And the amount we do that for is the amount we calculated, 30,930. And that's basically this question solved. Allowance for doubtful accounts questions become very easy if you can remember this table. If you remember this table and you just fill in the blanks, that'll make it very easy for you to complete this. Okay. So that's allowance for doubtful accounts completed. And in another lecture, we'll cover some of the other stuff. Thanks.